If you think consumer confidence is just another boring economic statistic, think again, because what just happened in the UK could quietly reshape your job security, your mortgage payments, your business revenue, and even the value of your home over the next 6 to 12 months. Consumer confidence has dropped again, and while it may not dominate casual conversations at the pub tonight, it is one of the most powerful early warning signals in the entire economy. When confidence cracks, spending slows. When spending slows, growth weakens. And when growth weakens, everything from hiring decisions to house prices can start to shift. So the real question is this: is this just a temporary wobble, or is it the beginning of something more serious? Right now, households across the UK are showing signs of growing caution. Recent sentiment data monitored alongside official releases from the Office for National Statistics suggests that people are feeling less optimistic about their personal finances and the broader economy compared to previous months' expectations about future income. Growth have softened. Major purchase intentions, things like cars, home renovations, and big household appliances are being delayed. And when millions of households simultaneously decide to wait and see, the economy feels it. Let's break this down in simple terms. Consumer confidence measures how people feel about their financial future. It's not just about what they earn today, it's about whether they believe tomorrow will be better, worse, or uncertain. And right now, uncertainty is rising, even though headline inflation has eased from its peak. Families still feel squeezed. Food prices remain noticeably higher than they were 2 years ago. Energy bills, while more stable than during the crisis period, are still a concern for many households. Mortgage rates, particularly for those refinancing off older fixed deals, are significantly higher than what people became used to during the ultra-low rate era. Now, here's why this matters so much. The UK economy is heavily dependent on consumer spending. Household expenditure makes up a large share of GDP. When people feel confident, they spend freely, they book holidays, dine out, upgrade electronics, invest in property improvements. That spending flows into businesses. Businesses then invest, expand, and hire. It's a cycle of momentum. But when confidence drops, that cycle slows down. Spending becomes selective. Businesses notice softer sales. Expansion plans get postponed. Hiring becomes cautious. And over time, that caution can spread. There's also a psychological element at play. Confidence is contagious in both directions. When headlines emphasize uncertainty, layoffs in certain sectors, or warnings about slowing growth, households internalize that narrative. Even those who are financially stable may start to pull back slightly just in case. That collective shift can become self-reinforcing. If enough people believe tough times might be ahead, they behave more defensively, and that defensive behavior can actually help create the slowdown they fear. Another critical factor is interest rates. The Bank of England has spent the past few years raising rates aggressively to combat inflation. Higher interest rates were necessary to stabilize prices, but they also increase borrowing costs. Mortgages, personal loans, credit card balances all become more expensive for households rolling off fixed-rate mortgage deals. Monthly payments can jump by hundreds of pounds. Even if wage growth has improved in some sectors, that additional housing cost can wipe out gains quickly. When households feel pressure from higher debt servicing costs, confidence naturally declines. This is particularly important for the housing market. Property confidence is deeply linked to broader consumer sentiment. If people feel secure in their employment and income prospects, they are more willing to commit to long-term financial obligations like buying a home. But if uncertainty increases, buyers hesitate. Transaction volumes can fall. Sellers may need to adjust expectations. We've already seen periods where the property market cooled in response to rate rises, and confidence data suggests that caution may persist. Small businesses are also watching these numbers closely. If you run a retail shop, consultancy, or online store, consumer confidence is directly tied to your revenue outlook. When customers tighten their budgets, discretionary spending is often the first to be reduced. That can impact hospitality, fashion, electronics, travel, almost every non-essential sector. And if revenue growth slows, business owners may delay hiring or expansion. This is how a shift in mood can gradually translate into real economic effects. Now, some viewers might ask, but hasn't inflation been coming down? Yes, it has moderated from its peak. However, the damage from the earlier surge in prices still lingers. Prices may not be rising as fast, but they are still higher than they were before. Wages have improved in certain sectors, but not uniformly. And for many households, savings buffers built during the pandemic have been eroded. So, even if macro indicators show improvement, the lived experience of households may feel more fragile. It's also important to consider global factors. The UK does not operate in isolation. Slowing growth in parts of Europe, geopolitical tensions, and global supply chain uncertainties all feed into domestic sentiment. When international news feels unstable, it affects business confidence and investor behavior, which can then filter down into job markets and wages. Financial markets respond quickly to shifts in expectations. Bond yields, currency values, and stock indices all adjust based on perceived risk. If markets interpret falling consumer confidence as a signal of weaker growth ahead, volatility can increase. And here's where things become particularly relevant for your personal finances. If consumer confidence remains weak, policymakers may face difficult decisions. If spending slows too sharply, growth could stall. In that case, the Bank of England might consider adjusting its policy stance sooner than expected. Lower interest rates could provide relief for borrowers, but they might also signal economic weakness. On the other hand, if inflation risks re-emerge, rates could stay higher for longer. This delicate balancing act creates uncertainty, and markets dislike uncertainty. Let's talk about employment. So far, the UK labour market has shown resilience, but confidence indicators can act as early warning signs. If businesses anticipate weaker demand, they may freeze recruitment. Temporary contracts may not be renewed. Overtime hours could be reduced. None of this happens overnight. It unfolds gradually. And often, sentiment data gives clues before official employment figures shift meaningfully. Another dimension to consider is household debt levels. Over the past decade, low interest rates encouraged borrowing, particularly in the housing market. While this supported growth, it also increased exposure to rate changes. As fixed-rate deals expire, households face refinancing at higher costs. Even if base rates stabilize, the adjustment from ultra-low rates to a higher baseline has already impacted budgets. That strain feeds into how confident people feel about their financial future. Retailers often serve as a real-time barometer of consumer confidence. If footfall declines, promotions increase, and inventory builds up, it signals softer demand. Corporate earnings reports may begin to reflect narrower margins. Investors react, share prices adjust, pension funds and investment portfolios feel the impact. So even if you don't directly work in retail, shifts in consumer sentiment can influence your investments. There is also a generational element. Younger households, particularly first-time buyers, face unique challenges. Higher rents, elevated deposit requirements, and rising living costs can make long-term planning feel daunting. If confidence drops among younger demographics, it can have long-term consequences for housing demand and family formation trends. Meanwhile, older households on fixed incomes may feel vulnerable to inflation and healthcare costs, affecting their spending behavior as well. One emotional factor that cannot be ignored is financial fatigue. After years of economic turbulence, from the pandemic to energy shocks to inflation spikes, many households simply feel tired of uncertainty. Even modest negative headlines can have amplified psychological effects because resilience has been tested repeatedly. When surveys ask households how they feel about the future, that accumulated fatigue influences responses. However, it's important to maintain perspective. Consumer confidence fluctuates. It rises and falls based on news cycles, economic data, and policy signals. A single monthly drop does not automatically mean recession. Economies are complex systems with multiple moving parts. Strong wage growth in certain sectors, improved supply chains, or stabilizing global conditions could support recovery in sentiment. But the key takeaway is this: confidence matters because it shapes behavior before official data confirms trends. If you are managing your personal finances right now, this environment calls for strategic awareness. That does not mean panic. It means reviewing your budget, understanding your exposure to variable rates, and ensuring you have an emergency buffer where possible. It means being informed about policy decisions from the Bank of England and tracking employment trends in your sector. Knowledge reduces uncertainty, and uncertainty is what undermines confidence. Businesses, too, may need to prioritize flexibility, managing cash flow carefully, avoiding overextension, and maintaining strong customer relationships become even more critical during periods of softer sentiment. Those who adapt quickly often outperform once conditions stabilize. Investors should also recognize that markets often price in expectations ahead of actual outcomes. If consumer confidence weakens but economic data remains stable, markets may stabilize quickly. But if weak sentiment translates into falling retail sales or slower GDP growth, volatility could persist. Diversification and long-term discipline remain fundamental principles. So where does this leave us? At a crossroads defined by caution, consumer confidence has dipped, not collapsed, but declined enough to raise questions. The coming months will reveal whether this is a temporary reaction to specific headlines or a more sustained shift in household psychology. Data on retail spending, wage growth, and employment will provide clearer signals. But remember this, economic shifts rarely announce themselves loudly at the beginning. They begin quietly in survey responses, in postponed purchases, in subtle behavioral changes. That is why confidence data deserves attention. It is not dramatic, it is not flashy, but it is powerful. And if you live, work, invest, or run a business, in the UK, staying informed is not optional, it is essential, because by the time the impact becomes obvious in everyday life, the underlying shift has already been underway for months. Right now, the most important question isn't whether consumer confidence has fallen. It has. The real question is how households, businesses, and policymakers respond next. Will caution deepen? Or will improving data restore optimism? The answer to that question will shape the direction of the UK economy and potentially your financial future far more than any single headline. Stay aware, stay analytical, and most importantly, stay prepared.